and welcome again. This is Robert Schein, Managing Director and Partner of Blanke Schein Wealth Management. Thank you for joining us for our market insights and observations. Today is July 6th, Thursday. I trust that everyone had a happy and safe 4th of July. Let's get right to what's moving markets. Markets pre-market this morning got the economic data showing that the jobs market, the labor market, is still super tight. We're going to discuss that. So markets sold off as a result and continue to be sort of working their way back in the midday as we report this. But it's still a sell-off today as a result of the labor market. And we're also going to talk about what that translates into potentially for the Federal Reserve, which means more hikes are on the way. And then let's look at, finally, we're going to talk about the valuation checkpoint of where the market is year to date for the first 6 months. But this is from CNBC earlier this morning. The jobs opening fall by 500,000. So the JOLT report, job openings, basically show that they're basically are hovering just about the 9.8 million job openings. It's down 500,000 from April, but it's still continuing to show that it's trending in the right direction for job openings. But more importantly, it's the report that came out from ADP private sector payrolls. And this was a shocking 500,000 adds to new employment data coming in June, as well as the ISM manufacturing index is well above 50. That's showing that economy is expanding. So you have a tight labor market continuing to need more workers out there with the manufacturing underneath. Just shows that the U.S. economy is strong, and that translates into ultimately the bottom line is that there's continued evidence that the overheating the U.S. economy and the labor market is likely to bother the central banks, and the Fed rate hike for July is very likely. Right now, Fed funds futures on a rate hike for July is about over 85% that they're going to hike. And the question is it 25 basis points now or is it 50? But the pause is really a skip ultimately for the Federal Reserve. So the Fed basically needs to continue. And this is the ADP payroll, just to show you in context from a visual perspective. Ultimately, it's been trending pretty good, but all of a sudden we got a big breakout for July, adding 497,000 jobs, which is good. On one hand, that's good, the U.S. economy. On the other hand, it just shows that it's going to be a difficult job for the Federal Reserve to work against inflation. In fact, the tightening is in the pipeline. As we can see, this is the 10-year Treasury yield on the blue versus where the Fed funds is, and they're significantly above where they are, and they're going to continue to keep basically the trend going and for interest rates. But you have to watch real rates closely, as that has a restrictive lag effect and a restrictive basically impact to the U.S. economy. Now, reminder, if we take a look back at the 70s and the early 80s, we sort of had what the Fed doesn't want is a repeat of this, which is a sort of a touch and go with regards to inflation. In the 70s, 74, 75, and this is actually a chart showing that CPI peaked in December of 74 back here, but yet yields didn't peak until 75. So there is that lag effect where even though the CPI will start coming down, yields will still stay above it ultimately. And what we saw is basically a bounce back of CPI back in March of 1980 when the highest it really was at this point in time. And then we had yields peak in September of 1981. Remember, Paul Volcker, the head of the Federal Reserve at the time, broke the back of inflation by basically getting the prime rate up to 21.5%. And ultimately, that was the anchoring effect, bringing inflation way down. And that's actually what set up a 2-decade expansion from the 80s and 90s for the equity markets. So we're kind of hopefully, in that zone right now where the Federal Reserve still needs a lot. There's a lot of work that needs to be done. Now, how does that translate into valuations with regards to the S&P 500 as it relates to inflation? So this is a good chart from Strategis, and it basically shows from 1950 to current, ultimately, if year-over-year inflation, basically we've categorized this in different sort of tranches, if you will. All the way to one side, you have if inflation is, sub greater than 10%. which is only periods of time through history. It's really, that brings your valuation of 8.3%, if you will, on a trailing, basically price to earnings ratio. Right now, the current market is about 19 times on the S&P 500. And so right now we have inflation in this category from basically going from 4 back to sub 4, if you will. So that puts the S&P valuation, let's do this so you can see it, from 19.5 where we are today, the S&P valuation, to about 17.4 if we were basically going in this direction. If we continue to go in the direction, then it gets better. That means that their market is fair valued. So ultimately, there are pockets and sectors that are still showing value. And in fact, if we look at year-to-date performance of the NASDAQ, it's close to 40% positive for the year. S&P 500 is up 16% for the first basically 6 months of the year. But the Dow Jones Industrial Average is only up 4.5%. So that's interesting. Rob, what's the Dow Jones Industrial Average? Well, if you remember, it's the oldest continuous barometer of the U.S. stock market, and it basically represents a composite of the 30 blue chip, basically the top 30 largest companies. So you've got every sector in there, from technology to energy to financials to materials, industrials, real estate. This is another sort of breakdown of what's inside and ultimately the composition of the Dow Jones Industrial Average. The reason why I bring this up is because there could be an opportunity, and this is what we're reading a lot in the press, is yes, the last couple of days markets basically have cooled off to kick off basically the second half of this year starting in July, rightfully so. But their question is there a catch-up effect for some of these indices? Think value stock versus growth stock. Growth stocks, which we own for our clients, have done very well year to date. We've trimmed some positions, and now we're rebalancing. We're going to pick up some value companies, again, anchored in the Dow Jones Industrial Average, because we believe that if the economy is strong, as we saw, if you want to stay ahead of inflation, you have to own basically real assets that grow above what the Fed's expectations are. And ultimately, if the Fed does get a hold of it, valuations, look at this. All right, here. Valuations still have an opportunity to basically come into line where we are if inflation still continues to come down. So that supports the market, and it actually supports a rotational effect into maybe what we could see is the Dow Jones Industrial Average, so the blue chip stocks. And so ultimately, why would be if you think about it, what makes up the largest sector weighting of the Dow Jones Industrial Average are financials by 20%. And year-to-date, financials and healthcare have been laggards, and that's a good, if you take those two together, about just under 40% weighting. So does that mean financials will continue sort of hopefully bring up the back end and have actually a rally? It's going to take some time. The Federal Reserve is going to slow that. Financials don't perform well ultimately when the Federal Reserve continues to raise rates, but once the Fed pauses at some point in time, and we believe at some point in time they will, then financials play a catch-up. That's why the Dow could be in position. But in the Dow, you still have information technology, industrials, consumer discretionary, and staples, and real estate, energy, communication services, and materials. So that's sort of around the sort of bases, if you will. Look at the different complexities in different markets of why you want to be diversified and balanced, because you don't want to have all your eggs in one basket with regards to all technology stocks, even though they've done very well this year, or growth stocks, if you will. Value still holds, and they still holds a sector weighting in the portfolio, especially for Blanke Schein Wealth Management clients, as well as they pay us a dividend, and that's also sort of a good pay us while we wait for value to catch up to growth. So it could take some time, but we're going to be patient, and that's the name of the game. Thanks for watching today, and we'll see you again next time. Hope all is well. Take care.